Today we will discuss accounting principles, or we can say kinds of accounting principles, and these principles can be classified mainly into two categories. First is accounting concepts and second is accounting convention. Accounting concepts, also known as accounting assumptions. What is accounting concepts over here? Concepts include the assumptions and conditions on which the science of accounting is based. This is also known as accounting standard. It means accounting concepts also known as assumption as well as accounting standards. And what is accounting convention over here? It includes the custom and traditions that assist the accountant, means to tell our accountants in preparing accounting statements, to tell our accountants about all the rules, regulations about custom and tradition and the way to prepare accounting statements, each and every terms assist our accountants. That is what accounting conventions. Now, accounting concepts. Accounting concepts are basic assumptions or fundamental propositions in which accounting operates. They are generally accepted accounting rules based on which transactions are recorded and financial statements are prepared. It is important to follow the accounting concept because it enables the users of financial statements. We have discussed already about the users of financial statements. There are two types of users, internal users and external users, to understand them better and in the same manner. In order to make the accounting language convey the same meaning to all people, and to make it more meaningful, most of the accountants have agreed on a number of concepts which are usually followed for preparing the financial statements. No enterprise can prepare its financial statements without considering these basic concepts or assumptions. These concepts guide how transactions should be recorded and how transactions should be reported. So first we will discuss about accounting concepts, or we can say accounting assumptions or accounting standards. Basically, there are three concepts: going concern assumption or concepts, consistency and accrual assumptions. Sometimes accrual known as matching concepts, we will discuss about it. First is consistency assumptions. Consistency assumption means today we have adopted a method. Today we have adopted a method to complete one task. And after 1 year, if we find out that we got profit after adopting that method, then we can continue that method and we can doing our work, we can doing our operating activities, and again we are getting some profit. It means consistently we are using that method to make more and more profit. That is consistency. So let's discuss about it. Once selected and adopted should be applied consistently year after year. The concept helps in better understanding of accounting information and makes it comparable with that of previous years. We can compare our current year data with the previous year data. Why we can compare? Because if we adopted one method in previous year, then again that method is adopted in current year, so that we can compare our data. This is consistency assumption. If a firm adopts different accounting principles in two accounting periods, the profits of current year period will not be compared with the profits of preceding period. For example, a firm can choose any one of the several methods of depreciation. There are various methods of depreciation: straight line method, written down value method. We will discuss about it. But it is expected that method once chosen will be followed consistently year after year. This is what consistency assumption. Companies should choose the most suitable accounting methods and treatments and consistently apply them in every period. Changes are permitted, changes are allowed only when new method is considered better and can reflect true and fair view of financial position of company. The change and its effect on profits should be disclosed in the financial statements so that our users must know about the methods which are used in the company. This is meaning of consistency. Let's take an example. If a company adopts straight line method and should not be changed to adopt reducing balance method. There are two methods, straight line and reducing balance in other period. And if a company adopts weighted average method as a stock valuation and should not be changed to other method like first in first out method and last in first out method like this. These are the types of the methods only. Next is going concern assumption. It is assumed that business shall continue for a foreseeable period and there is no intention to close the business or scale down its operations significantly. This implies that it will not be dissolved in the immediate future unless there is a clear evidence of closure. Suppose there are two partners in a company, A and B, partner A and partner B. Or we can say one more partner is there, partner C. If partner C retire, it's not like that company will be dissolved. No, company will not be dissolved in immediate future. It will continue for a foreseeable period. As per this concept, it is assumed that business will continue to exist for a long period in the future. Transactions are recorded in the books of business on the assumption, that's why it is an assumption, on the assumption that it is a continuing enterprise. On this concept, we can record fixed assets at their original cost and depreciation is charged on these assets without a reference to their market value. We have discussed about fixed assets. Fixed assets like our land and building, plant and machinery and depreciation is charged on these assets without reference to market value. Because of going concern concept, outside parties enter into long-term contract with the enterprise. That's why it is an assumption. We assume that our company will going or will continue for a foreseeable period. Business will continue in operational existence for the foreseeable future. Financial statements should be prepared on a going concern basis unless management either intends to liquidate the enterprise or to cease trading or has no realistic alternative but to do so. Let's take an example of it. Possible losses from the closure of business will not be anticipated in the accounts. Prepayment or depreciation provision may be carried forward in the expectation of proper matching against the revenue of future period and fixed assets are recorded at historical cost. Now, accrual assumption. A transaction is recorded in the book of account at the time when it is entered information and not when settlement take place. Thus, revenue is just like a profit. Revenue is recognized when it is realized. That is when sale is complete. Realized means when sale is complete or services are rendered. It is immaterial whether cash is received or not. In accounting, accrual basis is used for recording of transactions. It provides more appropriate information about the performance of business enterprise as compared to cash basis. It implies equally to revenue and expenses. In accrual concept, revenue is recorded when sales are made or services are rendered, and it is immaterial whether cash is received or not. The significance of these fundamental assumptions is that, in the end, we can say they need not be specifically stated in financial statements, and users of financial statements can take for granted that these assumptions have been followed while preparing financial statements. Thank you so much. Revise it. Try to make short notes of it.